Now let's get to how to find quality undervalued companies now. Because a lot of companies were underperforming substantially during the corona crisis with the lockdowns and whatever, I thought it would be better to start the screening from the point of view of looking for a quality company first, which means removing the worst 50% of companies according to gross margin marks. You know, gross margin mark is gross profit divided by assets. It's one of the only quality ratios we tested that really worked well. Debt to equity, obviously the old classic one, not to buy too leveraged companies. Free cash flow to debt, obviously this one's going to be a little bit affected by the factors on the free cash flow generation that I mentioned earlier, but a lot of these companies use a lot of this free cash flow they generated to pay down debt, which obviously is a good factor and makes the company a bit more quality worthy, you can say. External finance is another good ratio to be able to, the ratio just shows you, is this company able to finance its asset growth from cash generated by the business, or does it have to go and get external financing like bank debt to finance its asset growth? The studies or the tests we've done, you know, in spite of the academics that developed this ratio, found that this is a very, very strong ratio, even just on its own, to find good companies to invest in. And then we want to screen out value trap companies. Obviously, you know, they're always around, by looking at companies with strong momentum. To do that, we're going to look at companies with an adjusted slope value of greater than 30, or if you prefer price index, take it, greater than a value of 1.5, which means the share price increased about 50% over the past 6 months, as price index 6 months is calculated by the current share price divided by the share price 6 months ago. And then just to get quality companies first, then look for momentum companies to screen out value traps. And of these companies that are remaining, we want to find cheap companies to value cheap companies as defined with QI value. The QI value indicator, just to refresh your memory, consists of EBITDA yield, earnings before interest, depreciation, and amortization, divided by enterprise value. Earnings yield, earnings before interest and taxes, divided by enterprise value. And free cash flow yield as well. It's only one of the 4 factors, as we discussed previously. And then we also have low liquidity, companies that are not as highly traded per year compared to their total market value. And we found that that was also a really valuable ratio to find good quality companies. To give you an idea of what companies are coming up on the screener now. Oh, sorry. First of all, this is more or less just this quick snapshot of what the screen looks like. There's the gross margin Novi marks. We're taking the top 50 companies, getting rid of the bottom 50. Debt to equity, top 50 companies we want in the database or the screen. We want to get rid of the bottom 50. Free cash flow to debt, same story. Get rid of the worst 50% of companies. External finance, get rid of the worst 50% of companies. Keep only the best. I've got a small daily volume indicator, 80,000. That's enough for me to invest my own money. And here you can see the adjusted slope. I entered a number of 30. Click on this little magnifying glass and select greater than. See it's selected there. And then you'll only get companies that with a adjusted slope value greater than 30, and then sort by QI value. Here you can see the companies that the screen came up with yesterday. As you can see, there's a few forest products companies that obviously benefited by that huge spike in lumber prices in North America. They've come back greatly, but these are obviously companies with record profits that you want to avoid. The newsletter subscribers will remember companies like Oriental Watch Company. That one we recommended about, I think it was about a year ago. Anyway, the stock price is up 95%, but the company is still very undervalued. They paid 2 substantial dividends, and at the worst of the financial crisis, this company was already undervalued before that corona crisis dip in the markets came, and then the company bought back 20% of its stock. So biggest Rolex dealer in Hong Kong, I think probably all of Asia. Really, it seems like a super company that is still undervalued, even though its stock price has gone up 95%. Strabag, that's the Austrian construction company. That was also in the newsletter. Yeah, Manito was was recommended by the newsletter last month. Here's another lumber company, obviously record profits. Here's another newsletter company. As you can see, some companies with large once-off profits, the old story with the screener. You always get the worst companies or the companies with strong results, and you have to just ignore those ones with record results. Let's look using another composite value indicator, value composite 2. This one has got even more valuation indicators, and it's only got one related to cash flow, which is price to free cash flow. The other ratios that are all included in value composite 2 are price to earnings, EBITDA yield, price to sales, price to book, and shareholder yield. So there's a lot of classic value investment criteria in there. And as you can see, the results don't differ too much from QI value that we used previously. Forest Products, there's Oriental Watch again, there's Strabag again, another forest product company. The other ones, here's the one from the newsletter again, Manito, last month, and another forest product once-off record profits. So you have to ignore those. But these are basically good quality companies, upward moving share price, and they're still undervalued, which means they're probably still a good investment at the moment because not as expensive as those expensive US companies.